I am Marcia Peters. I'm the Chief Investment Officer of Portfolio Valuations, and the topic for today's discussion is the review of the fourth quarter economic and market performance. First, I'm going to discuss the market's reaction to the economic performance in the fourth quarter. At the end of the talk, I would also like to touch on the outlook for 2012 and spend some time on various economic forecasts. I'm going to focus on the assumptions built into those forecasts because I think they're very important to understand, in particular when you start thinking about the risks in 2012. And I'll conclude the discussion with some opportunities that are available to plan sponsors and investors. In the fourth quarter, we saw a move to a more stabilized economic and financial picture than we had experienced in the first three quarters. U.S. equity market performance was first driven by consistent corporate profits in the fourth quarter. Most corporations, or vast majority of corporations, I should say, posted earnings that beat all the estimates. As the quarter wound down, we saw finally a congressional agreement to extend the payroll tax cuts and the unemployment benefits. While they were only 2-month extensions, that still gave some stability to the markets. And the economic indicators that were posted in the fourth quarter also showed a sign of improvement in the U.S. economic picture. I'll discuss those a little bit in more detail in a later slide. But turning to the global picture, we also saw stability and calm return to the European credit situation. The ECB began to support the bond markets, in particular Spain and Italy, and began to provide bank liquidity, which went a long way to calming the markets and market participants' perceptions of the markets. That stability was also driven by fiscal austerity that was put in place by the new governments of Italy and Greece. And while those fiscal programs were planned for 2012, clearly they were a good indication at the end of the fourth quarter that was able to obviously give the market some stability. Greek debt negotiation also began to move forward, and that was an important factor in the stabilizing and calming of the markets. Last, there were indications that the Chinese economy, especially the monetary policy tightening that they experienced in the earlier parts of 2011, were starting to become effective and contain inflation. Clearly, most economists, as a result of that information, began to feel that the Chinese economy would enter a soft landing as opposed to a hard landing. Going back to the U.S. economic indicators that came out in the fourth quarter, they were clearly more positive. In particular, indicators related to construction, production, and manufacturing all posted higher than expected values. Now, a couple of things to consider in all of that. While construction spending was up, it was focused on multifamily homes. Factory orders and manufacturing numbers were also positive, but again, focused on the aircraft sector. Clearly, inflation, especially when you saw oil prices towards the middle part of last year start to dip, inflation remained low. Unemployment clearly, as a result, some of these indicators start to show improvement. And the fourth quarter GDP, which we didn't get until the beginning of this year, showed a 2.8% growth on the quarter. However, there were some indicators that were of concern, and these were indicators that are key to a sustainable long-term U.S. economic recovery. Those indicators were not as optimistic, one being new home sales, which was down 2.2%, and also consumer spending, which was flat. Consumer confidence indicators were down, people citing lack of jobs, obviously impacting their confidence and their ability to spend. And personal income, while it was up, it is starting from a very low rate. Both the personal income and the consumer confidence are really key to getting the consumer to start to spend again. And because these indicators were not as optimistic, they became the basis of economic forecasts for 2012. Before I discuss the economic outlook, though, for 2012, I'd like to just go over the market's reaction to some of the economic news that we had out in the fourth quarter. You'll see on this slide on page 5, there's a table of the broad market indices, their returns for both the fourth quarter and the entire year. Generally, fourth quarter was a reversal of the trend that we had seen on the overall year. Clearly, there was more stability by some of the information that I've already previously discussed, in particular with the European fiscal austerity and balanced budget rules that were put into place and the ECB support of the markets. It was a quarter that became, as a lot of people have termed it, a risk-on quarter, unlike the previous quarters, so that the market segments that we more associate with risk were the better performing segments. Clearly, the small cap, as you can see there in the fourth quarter, the value, the emerging markets in particular, all performed much better on the quarter than they did on the year. When you think about 2011, the overall picture obviously was not as rosy, although the year-at-the-end numbers, because of the fourth quarter performance, gave the impression as though maybe 2011 wasn't quite as bad a year as it was. But clearly that year-end print doesn't tell the true nature of the market throughout 2011. Obviously, as we all know, the markets were punctuated by high volatility, flight to quality, and really the whole notion of taking risk off the table and risk out of portfolios. In that scenario, the favored sectors and styles were the large cap segments, the growth, in particular technology, and the more defensive sectors like utilities, consumer staples, and dividend payers. In the low interest rate environment, a combination of that and better than expected corporate profits, the corporate sector looks like it has achieved what it needed to do in terms of improvements in productivity and efficiency, and clearly the dividend payers in this low rate environment have been the better performers. And of course, the U.S. Treasuries in the flight to quality, and also German Treasuries. German Treasuries also experienced a flight to quality. Clearly, developed Europe and emerging markets did not fare as well, especially for U.S. investors in emerging markets who also saw the double hit as the U.S. dollar appreciated. And lastly, the high yield corporate debt markets also on the year, as default risk premiums increased, maybe a little more than they should have, and probably overestimating default. Clearly, both the high yield and the corporate debt market did not fare as well. So turning to 2012, you'll see on page 7 there's some consensus forecasts for some of the large, big picture macroeconomic indicators. The Wall Street Journal every quarter surveys about 50 or so economists from many institutions and economic research firms and polls them for their outlook for these indicators. The outlook isn't overly optimistic. The economic picture, as many economists are calling it, is a muddling through economy for the U.S. in 2012. So you'll see here GDP in the U.S. is only forecast to be about 2.4%, while inflation still stays contained around the 2.25%. As part of this muddling through, though, the unemployment rate, while it may go down, is not expected to drop dramatically and probably will finish the year as they forecast around 8.3%. I've seen some economists actually say that it may actually go up in the beginning part of 2012 and then decline towards the end of the year. But no one is expecting any great improvements in unemployment, and likewise no major improvements in GDP. As we all know, the Fed has announced they're keeping rates unchanged until 2014, so no economist is expecting any Fed funds rate. Globally, the economic picture looks a little bit better, in part driven by Chinese GDP. Most economists are projecting Chinese GDP in the second half of 2012 to end up increasing somewhere in the 8 to 9% area. That will push global GDP up to the 3 and 3.5%. So overall, U.S. economy, this muddling through Global economy, a little bit better, but again, not anything that's going to cause any major shifts and portfolio restructuring. On page 8 and 9, we've summarized some of the forecasts for some of the major market participants and their economic outlook. If you just quickly scan both page 8 and 9, you'll see there's generally tends to be a consensus amongst the views. The comments and their views on the market are also very similar. There are a couple of outliers. Those outliers really tie to the economic picture in Europe, and it's a function of the individual organization's view on Europe. Where there tends to be a deviation, it is either that the organization feels that the European situation really will not stabilize and will get worse. In a couple of cases, in one case maybe, there's a situation where they feel that the European picture will improve dramatically. But before I talk about the global picture, let me turn to the U.S. economic outlook. Most economists, as I said, their outlook for 2012 is consistent. There are certain global themes that emerge consistently amongst all of these organizations. In the U.S., the overarching macroeconomic theme is the political uncertainty up till the presidential election in November. This leading up to the election, no one anticipates any major policy initiatives to be resolved. So issues like unemployment and housing will still stay at levels that they are at now. We don't expect to see housing prices improve or new home sales increase. Unemployment will stay high over the 8% area. And with regards to the budget deficit and the debt level, there isn't expected that Congress will make any significant progress on tackling those issues. As I said, the European recession, if it doesn't start in 2012 and hasn't already started, is going to drag on consumer confidence here in the U.S., and it's going to drag on exports. And so that's going to weigh against GDP growth here in the U.S. Another point to keep in mind is that fiscal stimulus, both at the federal level and the state and local level, continue to wind down, and that's also going to work against GDP. Inflation is going to stay controlled. There's still excess capacity in manufacturing and production. While there may be wage increases, it's starting from a low level, and stable commodity prices will also help keep inflation under control. Overall, the picture they paint is that consumer and business demand is going to be anemic and that there will only be moderate growth in the U.S. One thing I should note is that no economist is calling for recession in the U.S., unlike their forecast for Europe. Turning more to the global picture in Europe, most economists feel that the European debt crisis and banking crisis will stabilize, in part due to the austerity measures that are being put in place by the various governments, and also that monetary support by the ECB will continue. Those mechanisms that were put in place at the end of the fourth quarter to help improve liquidity and help banks recapitalize will all help stabilize the situation. And lastly, as I mentioned earlier, the soft landing in China, the potential for lower rates, not only in China but throughout Asia, should help drive European and global economic growth more towards the end of the year. So while there will be a recession in Europe, most economists see them coming out of recession by the end of the year, in part driven by their exports to China. In all of the assumptions that economists make, I think more so for 2012, the risks are much greater than I've seen probably in past years. And clearly there's more risk to the downside. The term most economists use are the fat tails that are concerning for 2012. And you'll see here on page 12, I have listed the kind of the key topics that are that really govern those fat tails. One being the deleveraging that's going to have to continue to go on, not only in Europe but around the world. And if that deleveraging, for whatever reason, breaks apart and does not continue in an orderly fashion, the European debt and banking crisis could begin to spiral and destabilize. That would set the entire economic outlook definitely off course. Associated with a destabilization would be the contagion and fallout from the Greek credit crisis. The ECB, unlike the Fed, is not a lender of last resort. They will support and have been supporting some bank debt and probably will continue to support the banks. They have been supporting bank debt by buying, sovereign debt rather, I should say, by buying Spanish and Italian bonds, but they're not there to support the entire sovereign debt market. One thing I also would like to add is that obviously there's a lot of discussion about Greece and the Greek debt. I don't have a slide here that shows this, but when you look around Europe and the banks within Europe and their investment in Greek debt is fairly small, somewhere on the order of 2% or lower. For example, Spain, I think, has maybe about 2% exposure to Greek debt. But when you look to the exposure that European banks have to Italy and Spain, it is much greater. For example, France has almost 17 to 18% exposure to Italy and 5% exposure to Spain. So while Greece is obviously an issue, it's the contagion of the Greek market that spills over into Italy and Spain that is the more concerning issue. And so clearly anything the ECB does to help support Italy and Spain is very clear. A couple of other risks are the Chinese economy. One question that always concerns me is how transparent is the economic data from China, and if indeed the economic data is not as good as it appears, that the Chinese economy could stall, and the real estate bubble, which has been subsiding, could actually spiral out of control too. Clearly, any Chinese recovery that stalls and is somewhat lower than the forecasted 8% is going to change the economic outlook for 2012. And the last topic is really politics and the lack of political leadership. Now, we've seen at the end of the fourth quarter, especially in Europe, a reemergence of some political leadership, but clearly 2012 will be a year where both the U.S. and the Europeans need to continue to assert political leadership with regards to deficits and sovereign debt and banking support. A couple of other issues that could surface are oil prices, as we've seen somewhat of an increase towards the end of the year, but still a lot less volatility than experienced previously. Any situation regarding Iran could change the oil price picture and I guess also destabilize the whole political scenario for 2012. So it's clearly something to keep an eye on as well. How soon will these risks become apparent? Well, in the U.S. here, starting in February, Congress will have to take up the extensions of the unemployment benefits and payroll tax cuts. As you know, they were only extended for 2 months. And that's where you'll start seeing discussions and political issues starting to play out here in the U.S. In March, a large percentage of Italian and Greek debt needs to be renegotiated. And so that is going to start coming back into the picture. So again, as I said earlier, the economic risks are much higher this year than we've probably seen in past years, again justifying probably not significant changes until a lot of these risks play themselves out, so to speak, or show that they become less important as the year goes on. If you turn to page 11, while the economic outlook is somewhat uncertain, there are still some opportunities. Equity valuations at the end of 2011 were favorable, more so in emerging markets than the U.S. Coming here into 2012, clearly we've seen improvement in the U.S. equity markets, and so equity valuations are somewhat less favorable than when we ended the year, but clearly still look like there may be some opportunities there. Corporate profits, as I said earlier, probably now have less upside from efficiency and productivity. They're going to be driven more by revenue. And one of the questions we have to ask is, where is that revenue going to come from? Reflecting on the economic outlook for 2012, it would seem that the revenue is going to come primarily from emerging markets, and as emerging markets improve and expand in the coming year, and probably more towards the latter part of the year. So that multinationals probably will be in a better position to capture that global growth. Given their efficiency and productivity, they should also be able to generate significant amounts of cash flow. That cash flow is important because it will allow them to continue to deleverage, and it will allow them to continue to pay dividends. Dividend payers and dividends have been important in 2011, and companies that pay dividends will continue to be important in 2012. Companies also may be able to expand dividends, providing they are able to generate cash flow. And clearly, companies that are able to increase dividends are going to provide somewhat of a cushion, especially if the market turns somewhat volatile. Fixed income is a little bit, there's a timing issue associated with fixed income, because while there are some opportunities there, clearly if the economic picture turns more to the risk scenario, then you're going to see more of a flight to quality. Corporate bond spreads, if the economic scenario stays stable, corporate bond spreads should continue to narrow. However, again, should the economic situation change, there is going to be a flight to quality. That's not to say that every corporate is going to be impacted, and there still may be some opportunities, but you have to be very selective in those corporate bonds. Likewise, in high yield, spreads at the end of 2011 were very high. They reflected a very unrealistic default rate. They have come in since the beginning of this year and are expected to continue to come in as spreads more accurately reflect a default rate of somewhere in the order of 5 to 7%. But again, it is a timing issue. It is a question of should the economic picture and outlook look worse. Clearly, the opportunities, you have to be much more selective in seeking out high yield. One thing we've also talked to people about are tactical and alternative managers, and the question is, are they better suited to handle market volatility, especially in times of turbulence when you see a conversion of correlations across all markets. Again, opportunities may exist there, but you have to be selective. They require a high level of due diligence, but that's not to say that certain managers could not be effective in a more highly volatile market. On page 13, I've summarized some of those opportunities for plan sponsors and investors. Again, multinational corporations, dividend-paying stocks, emerging market equity, all should benefit in a scenario where there is higher emerging market growth, there is cash flow being generated to multinational corporations to increase dividends, and that emerging market growth does outpace developed market growth, and that the potential for further interest rate cuts will continue to not only support the markets, but to drive consumer demand, which is a very important thing in Asia, and the further outlook for the Asian economies. Fixed income, again, it is a little bit more selective. High yield bonds and corporate bonds, there may be opportunities if spreads narrow, but managers that are chosen that manage in those sectors need to be cautious. And again, emerging market debt, especially if the inflation outlook is as anticipated, those governments will be allowed to reduce interest rates, and emerging market debt would benefit. But again, emerging market debt, likewise with the tactical alternatives, sectors need to have a fair amount of scrutiny. So in terms of next steps for plan sponsors, clearly the table on page 13 provides some guidance. If you go to our website, porteval.com, you'll see a link to a paper that summarizes a lot of the comments that I've made during this presentation. And also, we welcome your call, so please do not hesitate to contact your PEI representative to speak to them about the outlook for 2012 and some guidance. We know for plan sponsors this is especially important because at the end of 2011, given the equity market volatility, the equity market performance, many plan sponsors are below their target levels in equity allocation in particular. And so to the extent plan sponsors are able to rebalance at the margin, there may be some opportunities to readjust portfolios more in line with the economic scenario for 2012. So with that, I'll conclude this presentation, and thank you very much for your time.